Let's jump right in. Welcome to this explainer of the latest KINGFINITY Weekly Portfolio Market Brief, where we're decoding the absolute most critical signals that drove the markets for the week ending August 7th, 2026. If you've been watching the tape lately, you know it's been a total roller coaster, and this brief perfectly captures the underlying forces actually at play. Real quick, here is our roadmap for today. We're going to hit 1. The market's strange paradox. 2. The strongest portfolio signals. 3. Market pressure points. 4. Sector holds and volatility. And we'll wrap it up with 5. Next week's catalysts. All right, starting with section 1. The market's strange paradox, where bad news is good news. To really understand the broader market psychology this past week, we have to start right here. A surprisingly weak July employment report dropped, revealing 23,000 jobs lost. Now, this wasn't just a slight deceleration, right? It was an outright payroll contraction. Normally, you'd think that would spark absolute panic on Wall Street. But this brilliantly illustrates the market's strange paradox right now. Bad economic news was actually incredible news for equities. That economic warning of a shrinking labor market essentially forced a massive Wall Street rally. Why? Because traders immediately interpreted the weak jobs data as a guaranteed rate hike reprieve from the Fed. That reaction sent the 10-year Treasury yield falling to 4.64%, which acted like a massive tailwind, pushing both the S&P 500 and the Nasdaq surging to brand new records for the week. Moving right along to Section 2, the strongest portfolio signals. Quality growth takes the crown. So as those yields dropped, fresh capital went hunting. And the absolute clearest, most confirmed positive signal of the week? It came straight from the healthcare sector. Amgen stepped up to the plate and delivered a massive double-digit revenue jump, hitting $10.1 billion in the second quarter. What's really fascinating here is the sheer breadth of their operational strength. We're not just talking top-line hype. Their non-GAAP EPS hit $6.29, their free cash flow ballooned to an incredible $3.5 billion, and crucially, they actually raised their full-year revenue guidance. The market absolutely loved this verified, undeniable strength, rewarding Amgen shares with a 4.6% gain on Wednesday, and then they tacked on another 1.5% by Friday. But hey, this flight to quality growth wasn't just a U.S. phenomenon. International confirmation was every bit as strong. Look at Honda Motor. Their April to June profit literally more than doubled, hitting 456.9 billion yen on the back of a 13.5% bump in sales. Much like Amgen, Honda upgraded its annual forecast, and investors eagerly paid a premium for it, driving those shares higher in both Tokyo and the U.S. We saw a very similar story of pure execution over in European insurance. Munich Re demonstrated immense reinsurance discipline, posting a preliminary second quarter profit of 2.2 billion euros. I mean, they absolutely crushed the analyst consensus. They benefited from very low major loss expenditures and some seriously strong investment results, keeping their massive 6.3 billion euro annual profit target perfectly on track. Now let's pivot to Section 3. Market pressure points, where growth confidence is thinning. Because, let's be real, it wasn't universally positive out there. That weak labor data introduces some serious warnings, and Chevron perfectly illustrates this unstable sector reaction. Notice the massive disconnect happening here. Brent crude actually rose 1.3% on Friday, largely driven by political headlines, Iran-related diplomacy, and supply uncertainty. But despite those rising oil prices, Chevron shares actually fell 1.4% on Friday. The crucial takeaway? Shifting macroeconomic expectations are creating immense volatility that can completely decouple a stock from its underlying commodity price. Qualcomm is another fascinating example of this friction. They sit directly in a gray area of volatility right now. On one side, you have a very constructive rebound. Shares gained 4.6% on Friday, and the company is pushing great narratives around diversifying into auto and data centers. But on the other side of that tug of war, you have some serious unresolved debates about higher costs, specific Apple-related modem weakness, and slightly softer profit guidance. It is a true battleground stock right now. Which brings us to Section 4, sector holes and volatility, navigating the nuance. Beyond the obvious extremes, there are names requiring some real nuanced monitoring as this economic slowdown narrative develops. Take Gilead Sciences. This is what we'd call a solid defensive watch in healthcare. They reported second quarter revenue of around $7.8 billion, powered by the continued strength of their HIV franchise. Plus, they offered an improved sales outlook, nudging shares up about 1.8% on Friday. Now sure, acquisition accounting makes their earnings comparisons a bit complicated to read at first glance, but the verified operational strength makes it a solid hold. Then you have Texas Instruments, which tells a completely different story about market mechanics. Shares rose about 2.7% on Friday, bouncing with a broader semiconductor rebound. But what you really need to understand is why it moved. This upward momentum was driven almost entirely by lower Treasury yields and renewed risk appetite in the chip sector, not by any new fundamental data released by the company. It highlights how lower yields act like gravity in reverse, lifting duration-sensitive tech holdings almost indiscriminately. Meanwhile, over in Europe, equities like the prominent German automakers, BMW, Mercedes-Benz, Volkswagen, and Porsche remain highly exposed. They are facing persistent pressure from cyclical demand. We're talking high sensitivity around China market demand, ongoing pricing challenges, and tariff risks. For sure, they represent a clear ongoing pressure point in the portfolio. Finally, Section 5, next week's catalysts. Will the crown hold? So, what does this all actually mean as we close the books on this week and transition into a highly anticipated new week of trading? Well, this timeline maps out exactly what we need to keep on our radar. We get direct tests of rate-sensitive real estate with Simon Property Group on August 10th, then enterprise tech demand with Cisco on the 12th. But the main events, the absolute critical catalysts, are the U.S. inflation data drops. July CPI and PPI hit on the 12th and 13th, followed by retail sales on the 14th. If inflation comes in hot, it could rapidly reverse the very bond market relief that fueled Friday's rally. I want to highlight this overarching philosophy from the Queenmaker because it perfectly summarizes everything we've unpacked today. Right now, capital is ruthlessly rewarding businesses that can prove they are generating cash and hitting their guidance. Quality growth definitely wears the crown today. But that inflation data looming next week is the ultimate judge, jury, and executioner for this rally. Which leaves us with this final, absolutely critical thought. As we prep for next week's massive macro data, you have to ask yourself, does a softer employment number simply mark a controlled, healthy economic cooling that the Fed can easily manage? Or are we actually seeing the leading edge of a broader, much more painful corporate earnings slowdown? Look at your own watch list, look at your holdings, and ask yourself how well you're positioned for either answer. Thanks for joining me on this explainer. Keep your eyes on the data, and I'll catch you next time.